Good afternoon, everybody, and welcome to the June 2016 Quarterly Tax and Superannuation Update. My name is Josip Matanovic, and I'll be running through the taxation update. And with me today is Karrie Cheng, who will be running through the superannuation update. I'm not going to go through too much in relation to the budget, as much of the measures we're caught up in, in waiting on an election result. And on that front, I note the individual tax rate change proposed in the budget to lift the $80,000 tax bracket to $87,000 was not updated by the ATO as it was not passed through Parliament prior to the 1st of July. I guess I'll go through some changes to the thresholds. Taxation Determination 2016/7 specifies that for the purpose of Section 39A of the FBT Administration Act, the car parking threshold for the FBT year that commenced on the 1st of April 2016 is $8.48. The luxury car tax determination states that the luxury car tax threshold for the 16-17 financial year was $64,132. The determination also states that the fuel efficient car limit for the 2016-17 financial year is $75,526. The next cab off the rank is the TD 2016-8, which states that the car limit for the 2016-17 financial year is $57,581. The car limit is used to, work out the decline in the value of deductions of certain cars under the income tax law. The cents per kilometre rate was also updated for the year commencing 1 July 2016. It remains the same at 66 cents per kilometre. Taxpayers can claim a maximum of 5,000 business kilometres per car. Under this method, they don't need written evidence, but need to be able to show how they worked out their business kilometres, by producing some diary of records and work-related trips. Tax Determination 2016/9 provides an update of the amounts that the Commissioner will accept for the 15-16 year as estimates of the value of goods taken from trading stock for private use by taxpayers in certain specified industries. The table there on the slide goes through each of those per the type of business. Tax Determination 2016/11 adjusts the benchmark interest rate for the purpose of the deemed dividend rules in Division 7A of the Income Tax Act, and it's expected to be 5.4% for the 2016-17 income year. This is down from 5.45% for the 15-16 year. Tax Determination 2016/13 sets out the amounts the Commissioner considers are reasonable for the 2016-17 income year in relation to claims made for overtime meal allowances. That amount has come in at $29.40. Domestic travel allowance expenses, the reasonable amounts are given for accommodation at daily rates for domestic travel only, meals showing breakfast, lunch and dinner, and 3 deductible expenses incidental to travel. It also has covered travel allowances expenses for employee truck drivers. The reasonable amount for food and drink there is $97.40 per day. And it's also covered the overseas travel allowance expenses. Notice has also been gazetted specifying the repayment incomes and repayment rates for the Student Financial Supplement Scheme for the 2016-17 financial year. Where rates start kicking in is the income level of $54,869. They've been increased from CPI on the prior year. Again, the same changes have been made to the higher education loan program for the 16-17 year. Again, the income where the thresholds start kicking in is that $54,869, and where you're paying the top repayment rate is at $101,900. The Medicare levy low-income thresholds were also updated for 15-16 to increase the Medicare level individual income threshold to $21,335, the family income threshold to 36,001, and the child student component of income threshold for families for the 2015-16 income year to 3,306. There was also an increase in the Medicare levy low income threshold for individual taxpayers and families eligible for the seniors and pensioners tax offset, in line with movements in CPI. In relation to the R&D tax incentive, the ATO released a new checklist for the R&D tax incentive claimants. The ATO said the checklist will help the taxpayers self-assess eligibility, source advice on record-keeping requirements, correct mistakes and challenge decisions, and recognise red flags when dealing with promoters of aggressive R&D arrangements. Again, I'll just remind everyone listening, should you need any assistance with anything R&D related, please don't hesitate to get in contact with Kim Reynolds or Stephen Roberts at this office. The ATO is continuing its focus on trust, developing and selling properties as part of their normal business. The ATO said some trusts are incorrectly claiming the 50% CGT discount when developed properties are sold. As part of the Trust Task Force, the ATO said it escalated 75% of the cases reviewed for audit and have received voluntary disclosures. The ATO added that it will continue to target arrangements that display the following characteristics. Taxpayers have experience in either developing or selling property or experience in the industry, and establish a new trust to acquire property for development sale. Circumstances surrounding the arrangement are inconsistent with the stated purpose of developing the property as a long-term investment. The development is advertised as available to purchase before completion or is sold soon after completion, and the trustee claims 50% CGT discount on the sale of the property. From the 1st of July, all state and territory revenue collection agencies will need to collect and report information to the ATO about all transfers of freehold or leasehold interests in real property located in their state or territory. The ATO said it uses the information obtained from the real property transfers report to, among other things, expand its data matching with third-party reporter information, support voluntary compliance, by providing taxpayers with information related to CGT events that have occurred during the income year, and will make this information available through pre-filling for self-preparers and tax agents from the 1st of July 2017. Now this one's for, I guess, clients that are pharmacies, or you have clients that are pharmacies. The ATO has just released some information to help pharmacies avoid delays in processing unusually large GST refunds that may result from recent changes in the pharmaceutical benefit scheme. The ATO says certain hepatitis C medicines have recently been listed on the PBS. It says it's worked with the Pharmacy Guild and understands that pharmacies may claim unusually large GST refunds if you purchase these medicines. Further, they've gone to help reduce the likelihood of undue delays in processing such GST refunds. The ATO says it is important that the pharmacy's contact details, including tax agent details, with the ATO are up to date. The pharmacy lodges any BAS that may be outstanding or overdue. The pharmacy has provided the ATO with a valid Australian financial institution account, and the pharmacy's business industry code describing its main business activity as chemist or pharmacy operation. The ATO says that reporting the correct code will help it prioritise GST refund claims for pharmacies affected by this issue. There's a continued ATO focus. I guess the ATO is encouraging people to check which work-related expenses they're entitled to claim and understand what records they need to keep. The ATO has reminded taxpayers that there has been a change in the rules for calculating car expenses this year, and people need to use a logbook or the cents per kilometre method to support their claims. The ATO said it will be paying extra attention to those people whose deduction claims are higher than expected, in particular those claiming car expenses, including those for transporting bulky tools and deductions for travel, internet and mobile phone and self-education. For the first time ever, the ATO will check taxpayers' deductions in real time as they complete their return online. A message will appear if claims are substantially higher than others in similar occupations, earning similar amounts of income. the ATO will take a closer look at any unusual deductions and contact employers to validate these claims. I guess from our own internal point of view, we've seen a few letters in relation to clients with work-related deductions, basically alerting them to that their claim might be heavier than what would be seen by someone in the same industry on a similar income level. Then we'll continue focus on rental property owners. The ATO is encouraging rental property owners to better understand their obligations and get their claims right. The ATO will be paying close attention to excessive interest expense claims and incorrect apportionment of rental income and expenses between owners. The ATO are looking at holiday homes that are genuinely not available for rent and incorrect claims for newly purchased rental properties. The ATO has effectively extended the SuperStream deadline for small businesses by 4 months from 30 June to 28 October. While it recognised that over 450,000 small businesses had already implemented the required changes, it understood that some small businesses may need extra time to help become SuperStream compliant. The ATO announced that it will provide compliance flexibility to small businesses that are not yet SuperStream ready until 28 October 2016. Small business can select how their business becomes SuperStream ready. Options include using a payroll system that meets the standard, a Superfunds online system, a messaging portal, or a superannuation clearinghouse like the ATO Small Business Super Clearinghouse. The Small Business Super Clearinghouse is a free optional service for small businesses with 19 or fewer employees, as well as businesses with an annual aggregated turnover of $2 million or less. I'll go on to some of the state budgets that were announced during the quarter. First came off the rank was ACT. The ACT budget was handed down on the 7th of June. The ACT Treasurer Andrew Barr noted that the 16-17 budget completes the first of 5 years of the Territory's tax reforms. The Treasurer announced that the payroll tax threshold will be increased from $1.85 million to $2 million in 2016-17. He said that this means about 200 local businesses will no longer pay payroll tax, and all businesses with payroll of $2 million will receive an annual tax cut of $34,250. The Treasurer noted that the government has also cut conveyance duty by more than 30% for 3/4 of residential property transactions and for half of commercial property transactions. Stage 2 of the reform program starts in 17-18, and the government will cut stamp duty even further. Residential duty will be cut every year, and by 21-22, duty on an average Canberra home will be more than halved, saving the buyer of a $500,000 property $10,500. For commercial transactions below $1.5 million, duty will be cut by 50% in 17-18, and then abolished completely by 1 July 2018. Large commercial transactions will also see a further duty cut and will attract a flat duty of 5%. The Treasurer also confirmed that taxes on insurance will be abolished from 1 July 2016. The Queensland Budget was handed down on the 14th of June. The Queensland Treasurer announced a crackdown on state tax avoidance. He said the Queensland Government will target an additional $10 million in revenue over 3 years from those taxpayers who try and avoid tax. The Queensland Office of State Revenue will focus on key taxes such as payroll tax and land tax. The Office of State Revenue will focus on taxpayers incorrectly claiming to be not-for-profit organisations for the purposes of avoiding tax. The key revenue measures announced in the budget include, in relation to foreign buyers of residential property, the government will introduce a 3% transfer duty surcharge to be applied to foreign purchasers who acquire residential property in Queensland from the 1st of October 2016. For first home buyers, the government announced a 12-month boost to the Queensland First Home Owners Grant starting from 1 July 2016. Eligible first home buyers will now get $20,000 instead of $15,000 towards buying or building their new house, unit or townhouse, valued at less than $750,000. In relation to family farm transfers, the the Treasurer announced that a new family farm transfer duty exemption for intergenerational transfers of farm businesses. The concession will apply from 1 July 2016. The budget also provides grants of up to $2,500 for primary producers to get the very best advice on climate risks, financial management, succession planning, and multi-peril crop insurance options. There was also some grants to encourage hiring in regional areas. The budget announced a back-to-work regional employment package, which includes a back-to-work employer support payment of up to $10,000 for employers who hire and keep someone employed for 12 months or more in Queensland regions. This payment increases up to $15,000 if an employer hires a long-term unemployed person. The New South Wales budget was handed down on the 21st of June. The Treasurer referred to a number of the earlier announcements that were made, and these include the Jobs Action Plan being retargeted towards businesses with less than 50 employees, increasing the payroll tax rebate from $5,000 to $6,000 for each additional employee that businesses take on. New surcharge for foreign investors in residential real estate. A transfer duty surcharge of 4% will apply to all purchases from the 21st of June 2016, and the land tax surcharge will apply at a rate of 0.75% from 1 January 2017. Those surcharges are expected to generate about $1 billion in revenue over 4 years. The next measure was mortgage duty, share transfer duty, and non-real transfer will be abolished from 1st of July 2016, and those have been legislated. The Victorian Budget, I guess some of the key measures that came out of that was that the payroll tax thresholds will progressively rise by $25,000 a year over the next 4 financial years. The tax-free threshold will increase to $575,000 on 1 July 2016, and then $600,000 to 1 July 2017, $625,000, and thereafter. A new payroll tax exemption for wages paid or payable to displaced apprentices and trainees will be introduced from 1 July 2016. The foreign purchaser additional duty will increase from 3% to 7%. This will apply to contracts signed on or after 1 July 2016. The land tax surcharge on absentee owners will increase from 0.5% to 1.5%. The South Australian budget was also, I guess, announced. The key measures there included extending the small business payroll tax rebate and extending and expanding the off-the-plan apartment stamp duty concession. There was also an introduction of a wagering tax of 15% on net wagering revenue, expanding the PPR, or the primary place of residence land tax exemption, and a further expansion of the land tax exemption for sporting and racing associations. That's all I've got from a tax update point of view. I'll pass it over to Karrie now, who will go through the superannuation announcements.
Okay. So given Malcolm Turnbull's been re-elected, I'm just going to recap some of the major budget announcements that he's had. He's promised no more changes to super in this election term, apart from what's already been announced in the budget. But there have been a couple of little exceptions that have popped up from there. I'm also just going to cover some of the major things coming out of the ATO this quarter, including Safe Harbour Guidelines and then new early disclosure service. Okay, so one of the major budget announcements was surrounding how pension accounts would be capped from 1 July 2017 to $1.6 million. This was going to be indexed in $100,000 increments in line with CPI, and subsequent fluctuations due to growth were going to be disregarded. So those members who are already in pension phase will need to transfer the excess over $1.6 million to an accumulation account or withdraw the excess from super entirely. So that means that they're going to need to start paying tax if their pension accounts are over $1.6 million. If you don't withdraw it, then they're going to tax your excess anyway, and including the earnings on the excess amount. So I'd imagine the earnings are going to be calculated at the ATO defined rate, much like the excess contributions charge is currently. The Treasurer's also since confirmed that pension accounts that are or will be established from structured settlements or personal injury claims are exempt from this $1.6 million limit, and they can continue in pension phase without penalty. Okay. The other major one that's come out is the lifetime non-concessional cap, which applied from the 3rd of May 2016. This takes into account all non-concessional contributions made since 1 July 2007. Now, Bill Shorten's come out, I think he came out yesterday to say Labor will not be supporting the retrospective application, but not sure how that will fall. So currently, as it stands, if the member had already contributed over $500,000 from 1 July 2007, they are taken to have exceeded their cap. If the cap is exceeded after budget night, then the ATO will notify them to withdraw the excess. Also, I note that the ATO is receiving a record number of calls regarding historical non-concessional contributions. So they've stated that they can calculate the non-concessional contribution amounts for the period 1 July 2007 to 30 June, provided that all individuals and funds have met their lodgement obligations. So you can either give them a call, the fast key code is 4044, or request the information via the portal. If you call them, then they will provide you with a callback service within 48 hours with the information, and written and bulk requests will take a little bit longer. Now, we have utilised this service a couple of times, and we just recommend using the ATO data with caution, because there have been a couple of times where their data hasn't matched ours at all. Okay, so under the old non-concessional rules, individuals can contribute $180,000 per year with access to a 3-year bring forward if they're under 65. Under the new rules, it's going to be a lifetime limit of $500,000, and that includes your historical contributions from 1 July 2007. So the Treasurer has since announced some transitional provisions to enable additional non-concessional super contributions without breaching the $500,000 cap in certain circumstances. So if the fund had entered into, say, a property purchase contract before the budget note on the 3rd of May, then they can make additional non-concessional contributions to the extent necessary to complete the contract without breaching the lifetime cap. Your additional non-concessional contributions must still be within the limits of the old non-concessional rules. In addition, the Treasurer has said that members of SMSFs with existing borrowings will be permitted to make further non-concessional contributions to the extent necessary to ensure the legal obligations of the super fund that existed on or before the 3rd of May are met, or to comply with Practice Compliance Guideline 2016/5. So I'll be talking about that in a minute on the Safe Harbour Guidelines. So such additional non-concessional contributions will still be counted towards your lifetime non-concessional cap, but it won't result in a breach of the lifetime cap so long as those contributions are made until before 31 January 2017. So this is consistent with the 31 January 2017 deadline for super fund trustees to ensure related party limited recourse borrowing arrangements are on terms consistent with an arm's length dealing or the ATO Safe Harbour Guidelines. So once this is legislated, this 31 January 17 deadline is only going to be extended in exceptional circumstances and at the discretion of the Commissioner. Okay, so the ATO announced in May it's extended the deadline for all super fund trustees to ensure related party limited recourse borrowing arrangements meet the Safe Harbour Guidelines, so that's now extended until 31 January 2017. So they previously announced a grace period whereby it wouldn't select a super fund for review for the 2015 and earlier years, provided that arm's length terms were implemented by 30 June 2016 or the borrowing arrangement was brought to an end. The Commissioner has since received several requests from trustees for further time to ensure that their borrowing arrangements were consistent with arm's length dealings, and these requests also highlighted that taxpayers may benefit from further ATO guidance about some aspects of the non-arm's length provisions under Section 295/550 of the Tax Act. So the Tax Office has said it will provide further information and illustrative examples by 30th of September 2016. Now, the important thing to note with this one is the tax office does require that arm's length payments of principal and interest for the year ended 30 June 2016 must be made under terms consistent with an arm's length dealing by 31 January 17. So even though the deadline's been extended for the 16 year, you still need to be compliant, even if that means making catch-up payments in the next financial year. Okay, so under the Safe Harbour Guidelines, the loan-to-value ratio must not exceed 70% for property and 50% for shares and trusts. So that's the total loans, including any unrelated loans as well. It's not just your related party loans. Your loan term cannot exceed 15 years for property and 7 years for other investments. If you've got fixed interest terms, property cannot exceed 5 years for property and 3 years for shares. And your interest rate under the Safe Harbour Guidelines, they have used the RBA indicator lending rate, and this you need to be using this rate for the month of May immediately prior to the start of the relevant financial year. So this is actually a relatively new rate, so the ATO has specified that the rate of 5.75% is to be used for prior years. So that's the rate for property, but for non-property investments, you need to add 2% to this indicator lending rate. Okay, or borrowing arrangements under the Safe Harbour rules, you will need to be making a principal and interest repayments at least monthly. You have to have a secured mortgage, so your security must be registered, and a written executed loan agreement must exist. So here at Vincents, what we've been doing, we've analysed all of our clients that have limited recourse borrowing arrangements with related parties against the ATO Safe Harbour Guidelines. And for those who do not meet the requirements, we're looking through our options. So it doesn't just because they've released the Safe Harbour Guidelines doesn't mean that we necessarily have to comply. So currently we're looking at, can we justify the terms based on other commercial arrangements? So, for example, the fund may have gotten an offer for finance from an unrelated party such as a bank, and that may have exceeded the standard 70% loan-to-value ratio, or it may have had a longer loan term. So as long as we have that offer in writing, we would be comfortable justifying any variances to the Safe Harbour Guidelines, and we wouldn't be updating our related party loan agreements. Also, in some instances, we're finding that the interest and other expenses on the asset acquired under the borrowing arrangement could be far greater than the income on that asset. So having that asset classified as non-arm's length income might not actually have any adverse tax effects for the fund. However, just keep in mind you do need to report your non-arm's length income on your tax return, so this may raise the ATO risk rating for the fund. So here at Vincents, we do offer our clients audit insurance, and that covers up to $10,000 of our professional fees should the fund be audited or reviewed by the ATO. We'd further recommend, if you are considering leaving it as non-complying, to make sure that you do revert the loan and have it comply with the Safe Harbour requirements prior to selling the asset, so as to avoid any adverse capital gains tax implications. Okay, and also if we do choose to rectify, as I covered previously, we can still contribute non-concessional contributions up to January 2017, even if the members have previously exceeded the $500,000 lifetime non-concessional cap, if we are looking to fix the loan-to-value ratio there. If you are making any changes to your loan agreements, I'd also make sure you document all your changes and minute them appropriately. So other ATO updates, excess concessional contributions notices are now accompanied by a fact sheet only, and it's now a two-step process. So if the member wishes to pay up to 85% of their excess concessional contributions from the super fund, they will need to download the ATO election form from the ATO website. So I've got the NAT number on the screen there. Or they can download the form from their MyGov account. They need to complete and return this to the ATO within 21 days of the determination issue date that will be found on your excess concessional contributions notice. So if you choose to do this and you make the election within the required time frame, then your excess concessional contributions will not count towards the member's non-concessional contributions cap. Once the form's been completed and lodged, the ATO will then send a payment notice to the super fund that was nominated on the election form. The fund must then pay the nominated amount, unless there's not enough money in the member's account, to the ATO. The ATO will then offset this against any outstanding tax liabilities that the individual may have and then refund the balance to the member. So same thing with excess non-concessional contributions notices. It's a two-step process as well. So you can choose to release the excess contributions plus 85% of the associated earnings. So the ATO calculates that with their earnings rate. Or you can choose to pay the excess contributions tax. If you don't make an election, then you're taken to have elected to pay the excess contributions tax, which is option 2 there. So if you are looking to release the excess contribution, you have to download the ATO election form from the ATO website or your MyGov account and complete it and return it to the ATO within 60 days of the determination issue date. Once the form is completed and lodged, the ATO sends a payment notice to the super fund and the fund must pay the nominated amount to the member. The ATO will also automatically issue the member with a notice of amended assessment to include the earnings on the excess contributions in their tax return. All right, finally, the ATO's launched an early engagement and voluntary disclosure service that was launched in May 2016 for professionals to work together with trustees to voluntarily disclose unrectified contraventions where there has been a clear breach of the SIS Act to the ATO and put together a proposed plan of action or enforceable undertaking to rectify the contravention. The auditor will still need to report any contraventions via the audit contravention report, but the ATO will take the voluntary disclosure into account when determining the level of enforcement action required and when making a decision to remit any administrative penalties. So you can't use the voluntary disclosure service if an ATO audit or review is already in progress. As professionals, we should be engaging with the trustees as soon as we become aware of the contravention and seek to put together a rectification plan as soon as possible. So the early engagement and voluntary disclosure service is being marketed by the ATO to improve the client's audit contravention outcomes, including having administration penalties remitted. The disclosure will be risk assessed by the ATO and will generally result in an ATO review to consider the proposed enforceable undertaking or rectification proposal. If the contravention is rectified as part of the voluntary disclosure, the ATO will not initiate an ATO audit when the auditor lodges their audit contravention report, so long as new matters have not arisen as part of the SMSF audit. So because they are going to do a review, we will definitely be recommending audit insurance if you are going to be using this service as well. I've just put the contact details there on the screen, so you can you'll need to complete the form and fax, post or email it to the ATO.
Well, if you've got any questions, feel free to send them through to those contact details on your screen now. On behalf of Karrie and myself, thank you for listening in, and we wish you a good afternoon.